Today's webinar is meant to help the small business owner know what is important at this stage of the year, coming up to the end of the year, in relation to their bookkeeping, which ultimately, of course, affects the tax return, right? So everything bookkeeping, the results of the books throughout the year are what drives the results of the tax return and your tax liability, right? So today we're going to kind of focus not on taxes and deductions so much as the elements of the bookkeeping that you need to be aware of and that you should probably be looking over to make sure that these elements are correct so that the tax return ends up being correct. Okay, so we've got a kind of a punch list of items here that we've come up with that are the common things that we're looking for in our clients' books before the end of the year to make sure that things are accurate for the tax return. We will also open it up for questions to allow you to submit questions that you might have about this topic, and we will address those at the end of the program. So to begin our list of items here, we're going to start with unclassified transactions or miscellaneous transactions. Okay, very often we get the question of, you know, if I've got a bunch of things in miscellaneous, is that going to be an audit flag? You know, is the IRS going to see, oh, they've got a bunch of things that they haven't identified as to what they are? We're going to go audit them because we think that's maybe things that should not be expensed on the books. So the answer is miscellaneous an audit flag? The answer is yes, if it's big. Okay, so as long as it's not too big and it's reasonable to have some things in unclassified. Now, to have a large amount of transactions in unclassified, not usual. Okay, so we usually say a max of $3,000 is kind of, we like to have $3,000 or less in our clients' unclassified expense or miscellaneous expense accounts if possible. You know, it varies. If you've got, the more revenue you've got, maybe the more tolerable your miscellaneous expense can be. But we, as a general rule, say $3,000, keep it below. So for you as the business owner, be looking at your profit and loss, right? Your income and expense accounts, and look for that miscellaneous or that uncategorized expense. And if it's over $3,000 or if it looks like it's higher than you want it to be, you know, go in there and provide your accountant with the information about those transactions so they can get them moved, right? So you're going to review the detail of that account, looking at each transaction, saying, oh, that was written to my contractor for this or that. Provide that information to the accountant so they can get it reclassified. Okay. Item number 2 is loans. So there's a lot of things that can go wrong with loans or with the accounting for loans, which may or may not result in problems on the tax return, meaning you paying too much or too little taxes on the tax return. For example, one of the main issues with loans is the breaking out of interest expense from the principal payment, right? Because if you recall, interest expense is different from the principal payment, and they have to be coded to 2 separate places on the financial statements. Here we have an example, profit and loss, and a balance sheet. So every loan payment that is made on a car or on a business loan is usually made up of these 2 components, interest and principal. And when we see that transaction go through the bank statement, we know that that payment has these 2 components and needs to be split. So we code the interest expense to the profit and loss. Okay, that is an expense reducing your net profit and thereby reducing your taxable income and the taxes you pay. The principal portion of that payment does not go to the profit and loss. it goes to the balance sheet, to the loan liability account. Okay, and this has nothing to do with your taxable income in general. Okay, so the principal payment goes here, does not affect taxable income. The interest expense, the interest portion of the payment goes here and reduces your taxable income. So getting that correct, making sure that those payments all throughout the year have been split out properly, is an important part of making sure you're getting all the deductions that you deserve and that your tax return is accurate. So that's an important place to look. And often that's why accountants, and we here at Mizuma, always ask our clients for a year-end loan statement, okay, showing how much, what the balance on the loan is at the end of the year, and also maybe the year-to-date interest expense, so we can true that up if we haven't been getting it exactly right throughout the year. Okay. Second thing that can go wrong with loans in the small business world that we are also familiar with is that when you get a loan from a company and you deposit it into your bank account, unless your accountant is aware of that loan happening, there's a possibility that they could record that deposit as sales income instead of as a loan. Okay, so that of course is not what we want. We don't want to be paying taxes on loan money, because when we receive a loan, it is not taxable. All right, so, but like I say, this happens sometimes where money will come in, be deposited into the bank account, and the bookkeeper, the accountant, can't really differentiate it from other deposits that are coming in, and so they'll assume it's income, and they'll code it right here to sales, which of course is driving up your net profit. If loan deposits go to sales, that's a big error, and we really want to avoid that error. So for you as the business owner, keep in mind when money is coming into the bank account that is not sales income, that is a loan from a bank or from a person or from another company, that you need to let your accountant know that this is a loan, this is not income, this is not sales that I'm depositing into the account here. Okay, makes sense? All right, our third topic for the things to review, things to be aware of for your bookkeeping towards year end is this equity component. We start with owner's distributions, and really these two kind of are similar, owner's distributions and owner's contributions. Owner's distributions are when the owner of a, also known as owner's draws, okay, when the owner of the company pulls money out of the company for personal use. That's an owner's distribution or owner's draw. Okay, and that gets coded when we see that withdrawal out of the bank account. There's no place for that here on the profit and loss, and therefore that is not affecting the net profit. Okay, I want to make sure that sinks in. When the owner pulls money out of the business, it is not income, it is not expense, it is not having any impact on the net profit of the company. On the other hand, it's being coded here to owner's distributions on the balance sheet in the equity section of the balance sheet. Okay, this is equity section. There's our liability section. Owner's distributions are being coded right there. Okay, and it's so when you pull money out of the company, it's important that your accountant knows that that is not an expense, so that this net income number isn't pushed erroneously too low. Also, the other thing that often happens here is that instead of maybe the owner just pulling a transfer or transferring money out or writing a check and pulling that money out in lump sums, maybe they'll say they're out and they're on a family trip and they decide, even though it's a personal trip, they decide to put that hotel night stay on their business card, or they know there's money in the business bank account and they need to buy their kid a bike and they don't have their other card with them, so they buy the bike on their business account. Okay, personal transactions, right? Personal expenses being run through the business. That is an owner's distribution in effect. It represents the same thing as if the owner pulled money out into their own pocket and then paid for the bike or then paid for the personal trip. It's the same thing as if they wrote themselves a check versus swiping the card and purchasing the item itself. So owner's distributions should be full of the owner writing themselves a check or transferring money out of the business account into their personal account. And it would also contain transactions representing personal use items. Okay, so as the business owner, and if you want to review your books, that is an area that you'd really want to look at. Because what if there's a transaction going through there that your bookkeeper or accountant believed to be a personal expense or believed was a transfer out of the company into your own pocket as the owner, but really wasn't, but maybe it really should be a supplies expense or a travel expense, something along those lines. You're not getting a deduction for it if it's sitting here. So you want all of the business deductible items to be sitting in these expense accounts. So it can go either way, right? You can be erroneously including owner's distributions in your expenses and thereby driving your taxable income too low, or you can be accidentally recording expenses to owner's distributions and lifting your net income up too high, your taxable income too high. So that is something that is probably one of the most critical areas to review as a business owner to ensure you're getting all the deductions that you deserve, that nothing is being missed or called an owner's distribution that shouldn't be. All right. And on that similar topic, owner's contributions, if you're putting money into the business, you certainly don't want that going to sales, right? That's kind of like the loan conversation that we just had. Money that the owner is putting into the business is not taxable. So we don't want that being coded to sales. We want that being coded to equity. All right. While we're on this topic of equity and net profit, I want to reiterate what I said previously, is that the money the owner pulls out of the company has no bearing on this net profit number. This net profit number is made up of sales minus all your expenses to get net profit. And that is the number you are taxed on. Okay, not this number, not how much money you pull out of the business. You're purely taxed on the net profit of the company. Okay, income minus expenses. And then from there, whether you leave the money in the business or you pull it out as an owner's distribution, that has no bearing on this net profit. This is the number that is going to pass through to your personal tax return and be taxed. Okay, so I want to let that sink in. Occasionally, I get questions from clients that are concerned about pulling money out of their business, and they think that the action of pulling money out of their business is going to trigger a new tax or a new taxable event. But that's not the case. You're being taxed on everything you earn every year, regardless of whether you leave it in or pull it out. Okay. So I hope that helps you as a small business owner know some areas to review to make sure your books are accurate, and to ensure an accurate tax return, ensure you're getting all the deductions that you deserve, ensure you're not paying too much taxes, but also not paying, that you're not gouging and abusing the system and paying too little taxes either. One more item that we have on our board is the topic of health insurance. Very often we get the question of how is my health insurance deductible, and how is it deducted and all that. There's a clear reason why this is such a complicated issue. It's because of the way the IRS wrote the rules that make us treat it different, it shows up different than a normal business expense on the tax return. And so there's a little bit of finagling that has to go on in the bookkeeping and on the tax return to ensure that it's done according to the IRS rules. Now, if you are a sole proprietor or a single member LLC filing a Schedule C on your Form 1040, so you're filing a sole proprietor's small business tax return, Schedule C, your health insurance is not reported as an expense, but it's reported as a AGI adjustment up on page 1. So you don't record all the expense down in Schedule C for health insurance. It's pulled up outside and deducted as a personal deduction. And we don't want to get too much into the details here, but so that's how it's treated for Schedule C. For S corporations, on the other hand, you've got the deduction being shown as officer salary. So all the premiums that were paid out of the business for the owners is reported as an officer salary expense. That is then added to the owner's W-2 income, and then deducted again at the same place where the Schedule C is. Premiums are deducted as an AGI adjustment on page 1 of the 1040. So what does all that mean? What does that matter? Just make sure your accountant knows the total of the health insurance premiums that you paid and whether you paid those through the business. That's the most critical thing. And number 2 is make sure your payroll provider, if it's not the same accountant, knows the same thing, the total health insurance premiums you paid during the year. Okay, and then leave it up to them to get it right. So there's our 4 main topics. Hopefully these have helped you know what you as a business owner might need to look into as you're going through the books at the end of the year. And I guess now we will open it for questions. Is that right? Okay. Looks like we've got our first question coming in here. It's from Sue in Visalia, California. Says, how do I write off my home office expense if I've been paying for it with my personal bank account? Great question. Great question, Sue, because she picked up on something here, right? She knows that she's been paying for her home office utilities and all those expenses through her personal bank account, and therefore those items are not going to show up on her profit and loss because we're just reconciling the business bank accounts to get the income and expenses of the business. But when you have these extra expenses that you're incurring outside of the business account, how do you get credit for those? Now, depending on whether you are a Schedule C filer or an S Corp tax business, S Corp entity, the way you handle this is different. So on a Schedule C, it's pretty simple, and it's just a little bottom section of the Schedule C where you just add the home office expenses. Okay, and that further deducts the profit from the that you've calculated here. So you'd have like home office expenses in addition to all of these others and take your taxable income down further. So that's just added on at the bottom of Schedule C for sole proprietors. Now, S corps or multi-member LLCs, there's no real good place for the home office deduction. There's no extra spot like there is on the Schedule C, designated spot. So the way we handle this is that if you've been paying for personal expenses, or sorry, business expenses out of your personal account during the year, then we would get a record of what those expenses are and the total amount. And then we will reclassify some owner's distributions as expenses. Okay, because what effectively the money you took out and that was coded as an owner's distribution, really a portion of that wasn't used personally. A portion of that was used for utilities or whatever those business expenses were. So that is a great example of something that needs to be reported to your accountant at the end of the year so that they can make that reclassification, take some of those owner's distributions, put it in as an expense, lower your taxable income, pay less taxes. Okay, great question, Sue, thanks. All right, so this one is from, got one more, time for just one more, maybe a couple. Greg from Tri-Cities asks, I haven't been keeping track of my mileage. Greg, you're not the only one. Can I still get a deduction for that? How does that work with my bookkeeping? Good question, Greg. You picked up, you realize it's not going to show up here, right? Your gas expenses, if you're running your gas through the bank account, that would show up as an auto expense. But if you're not running your gas through, or if you use mileage as your auto deduction instead of actual expenses, then the mileage isn't going to show up. So first of all, on as far as tracking it, the IRS rule is that you have to track your mileage, and you have to do that for at least 1/4 of the year, keeping detailed records, a detailed log of where you went, how many miles it was to get there, and what was the business purpose. Okay, so if you haven't been doing that, I don't know of a single tax accountant that would say, absolutely not, we're not taking any mileage deduction because you don't have a log. Now, I'm sure they're out there, but the more business friendly, I guess, accountants would say, hey, you know what? Start keeping a log, use an app to start logging your miles. But for now, report to me what your total miles were for business, and we will add that on as a deduction. So how is that done? If a client tells me they've got 10,000 miles, and if they had to go back and produce a log, they could go through their calendar, and they would, and they could, in the face of an audit or something like that. And I'd say, okay, the rate for this year is somewhere like 55 cents a mile. The IRS has given us. So $5,500, 10,000 miles gets you a $5,500 deduction. Certainly one you wouldn't want to miss. And we do it the same way that we would add those home office expenses, so as if you were paying for the auto expenses personally. Okay, so we take those expenses out of owner's distributions and reclassify them as an expense on the profit and loss. Okay, we say all this money the owner was taking out wasn't really all for him personally. He or she was using that money to maintain their vehicle and operate their vehicle. So you certainly deserve a deduction for that, an expense for that. So we take it out of owner's distributions, reclassify it as an expense here, and get the deduction that way. All right. Last question. All right, so here we go. Jason from LA asks, how far back can I go to capture expenses? That's a good question. It's not uncommon for clients to say, you know what, I started this business last year. And I incurred some expenses last year that I didn't take. Can I add them onto this year's tax return? The straight answer to this is that you can go back to January 1st of the current year. Okay, that's, you report your taxes year by year. So if you miss something in the bookkeeping because it didn't happen in between January 1st and December 31st, then technically you don't get to take that deduction in that year's tax return. However, you can go back and amend that prior year tax return in order to capture those deductions. And amending a return does not throw an audit flag. You shouldn't have any hesitation to doing that. If those deductions in prior years are significant, you would want to go back and capture those. But it's taken as a year by year, and typically on a cash basis. When you paid the expense, the date that you paid the expense, that year is the date at which you get to take the deduction. Okay, so I think that's all of our questions for today. Thank you for joining the webinar. I hope we've given you guided you into some of the really key areas that you need to be looking at in your bookkeeping to ensure things are accurate for the tax return. See you next time.